All right, Dave, we're recording. And before I introduce you, I'm going to give you the ability to share your screen with us here later on, because I know you're going to want to do that. And
am I clicking anything to?
Nope.
Okay.
There you go. Uh-oh, I did the wrong thing. Darn it. I got to find you, Dave, and bring you back. Hold on. Dave, you're back.
I'm here. Yes, sir.
I made a little boo-boo there.
At least it wasn't me.
No, it was not you. I still got to see if I can get you over there. Oh, I don't know if I have the ability to do this. All right, hold on one sec. Sorry, guys, those of you that are watching and waiting here. All right, now, Dave, you have the ability to share your screen. So without further ado, thanks, guys. Let me introduce Dave Hurst to you guys who are watching from wherever you may be. I'm going to explain the audience to you in just a little bit here, Dave. Dave is the Vice President, and I have to read this because it's a pretty good title, of the All-in-One Loan Finance Business Operations. What that means is this, guys. Dave has been involved with a company that has been providing this loan wholesale to us brokers for a number of years, and he's been involved in one capacity or another for 14 years now. He is the optimum guy to tell us about everything that you might want to know about the all-in-one loan. He's now the head of the whole operation. So he's been through marketing, he's in sales, he touches overall operations and all of that. So we're really privileged, Dave, and thank you so much for being able to spend some time with us today and tell us about the all-in-one loan. Appreciate it.
Oh, thank you, John, for having me on.
Absolutely. So let's begin. A little overview. If you were to chat with somebody at the proverbial barbecue and you were telling them about what the all-in-one loan was going to be, is all about, what would you say, please?
You know, it's a great question. The one thing about this loan is that it provides so much value to people. It provides optionality, a very high level of optionality. And the hard part about it is just summarizing it in a couple sentences, making it very easy for people to digest. It's much more of a financial tool than it is just a home loan. And so the way that I would summarize it, backyard barbecue talk, I guess, is I would open up a conversation talking about the fact that we engineered a loan program that pays principal first. Just applies all payments to loan principal before the interest is ever even computed or charged. And that allows, for the start of a great conversation, people are pretty curious to understand why a lender might do that. But also, I think it becomes pretty easy from that point forward to conceptualize the benefits of that, financially speaking. If you're able to pay principal first, then you're able to reduce your balance faster, and therefore you're able to actually reduce your total interest. And that's a good thing. That's what people are looking for today.
Okay. Now, answer that question directly. I get that question a lot. Why does this lender offer a loan that pays principal first so there's less interest to the lender over time?
Yeah, it's a great question. I think it's you know, in my experience, understanding the consumer very well these days, I think we all tend to be skeptical of anything that sounds consumer friendly coming out of our industry. The answer to that is actually pretty obvious. The benefits of the loan are pretty vast. It not only pays principal first, John, but it also allows homeowners to use their home's equity dollars freely over 30 years without ever having to refinance again, at least throughout that loan's term. That empowers a borrower, whether it's a home buyer or an established homeowner with a mortgage today that refinances into the all-in-one. It now empowers the client, us, the consumer, the borrower, to actually become a little bit more proactive with their debt, paying it down maybe a little bit more aggressively. If you're able to actually put a little bit extra dollars into it and you have the freedom to take those dollars back out, then ultimately you have the ability to really take more control of your payoff timing, your principal reduction, and your total costs. With that said, you know, the likeliness of our borrowers, all of us, having future financing needs, borrowing needs, are pretty high, right? The typical customer does something with their mortgage about every 5 years historically. Right. And, you know, what's neat about this loan is that those future borrowing needs are already, you know, baked into the loan. They come with it. So we spend less money trying to retain customers. We just don't lose them. When you, as a partner of CMG, make this loan for any of your clients, which you have in the past, John, you know that if a borrower needs to borrow money again, they don't have to go get another transaction. They don't have to start the clock all over again. This loan comes with that ability to be flexible. So we lose clients less. We spend less money trying to acquire customers. It creates a loyalty package already built into it, in a sense. Loyalty may be the wrong word. It just creates an opportunity to generate a deeper relationship, lender to borrower relationship, than a traditional mortgage product. And that's purely it. Yes, there's profit involved, but we get to retain customers and really service them the way they'd like to be serviced for longer.
All right, great. So you've spoken to the client who has the loan, and the benefit to them is that they're going to reduce interest expense over time. And it's going to become more clear, guys, when Dave shows you the mechanics of this loan, how that all works. But before we go to that, Dave, let's speak to two other portions of our audience. Let's speak to a financial planner. Why would they might be interested in this loan for their clients?
Yeah, the one thing about mortgages that I think is often missed in the conversation we have with really everybody, a consumer, a real estate professional, a financial advisor, any stakeholder that is interested in helping borrowers or homeowners with their finances and improve their financial well-being. The one thing that I think is often missed in the dialogue is their exposure to interest. I'm not talking about interest rate, I'm talking about total interest costs, because those are the real dollars you have to earn and spend. And mortgage products come with a ton of interest. It's really common knowledge that owning a mortgage means that you're nearly doubling your home's original purchase price in total.
Exactly.
Yeah, and that's a financial impediment. I don't think that a lot of folks are really speaking about mortgages as an obstruction, as a financial obstruction, but they are, just simply because of the way they're designed. By redesigning it and offering a mortgage product that's purely designed to help reduce that interest cost, it opens up opportunities, right, to now use your own resources, your hard-earned dollars, towards other things more aggressively. That's securing your financial future, protecting your family properly with insurance products, all the things that a financial advisor is in place and provides for their client base. Simply put, if their clients have more money left over at the end of each month because they didn't need to spend it on mortgage interest, they have an easier time fortifying their finances, right, their financial future. So, we spend a lot of time speaking with financial advisors, and this is the one thing that they see the most value in. Okay,
great. And how about a real estate agent, Dave? Why might they be interested in this loan for their clients?
Much the same reason, John. Ultimately, I think statistically and historically speaking, about 20% of the housing market considers buying real estate, another home potentially, about every 5 years or so. And the vast majority of home buyers also historically are established homeowners, people that have already purchased, and maybe they're purchasing up, maybe purchasing across town. Maybe their family's growing, so they need a larger home, or just simply want to move to a better school district for their family. Either way, if real estate professionals, past clients, and the current ones they're working with today simply had more money, right, available, more of their own resources saved up, then home buying would be a lot easier, truly. And that's just, so the way that we accomplish that is manufacturing a financing tool that provides is designed purely to help reduce the size of interest, the total interest that you have to spend when you have to borrow money for a house. And that's purely it. It makes home buying more possible, makes it faster, makes it easier to do because you spend less on actual finance charges.
Okay, and guys, I want to interject here. It's a perfect time to let you know that there's been some enhancements to this product I've seen just recently from CMG. One is, in the right situation, you can go up to 90% of the value of your owner-occupied home. And it's also now available for investment properties. So those of you who are investors thinking about that, it works just the same there as well. And there's the benefits, Dave. Let's dig into this loan, the mechanics of it. You can either show your screen or whatever's easier for you. How does this loan work in such a dramatic manner to save so much interest?
Let me do that. Let me pop over to my PowerPoint, if you don't mind, and I'll use a few slides here to help demonstrate how it actually works, John. So let me scroll through, and here we go. And if you don't mind, let me just, I'll use about 5 minutes or so of our time to really discuss and draw some visual aid to help me describe the loan in general. So What is it? The easiest way to think about this loan product is as an offset mortgage. An offset mortgage is not a new mortgage type. It's an actual product or category of mortgage products. These are products that have already been in existence globally. They're very popular throughout Western Europe, Canada, New Zealand, Australia, predominantly in countries that have removed any tax benefit for paying mortgage interest. And of course, here in the United States, they're also used predominantly in the private banking space. So if you're a private banking client of a very large bank here in the US and you have a lot of money invested and potentially some cash on hand, and you also have your mortgage with that bank institution, they might offer you an offset account. And let me describe to you what that is, because this is the foundation of the all-in-one loan. Here's how an offset mortgage works. It really comes with two components. Number one is the home financing, right? The mortgage. And again, here historically, what we've been selling and buying as consumers to place on our homes and to buy our homes with are closed-ended instruments that really don't allow a lot of flexibility. And they also come with an amortization schedule. So your repayment terms are determined at closing, and it's hard to veer from that. It makes it very hard to actually prepay or pay a little bit more aggressively, because you might add some risk because you don't get access to those funds back if you ever need. So, but just to describe this, one part is a mortgage. The second component of an offset account really comes with a cash account or an offset facility. And this provides you the ability to actually make a deposit of some cash, generally speaking, large sums of cash. And the benefit here is that these two components work together. So the cash is leveraged automatically to help offset the amount of interest you have to pay on your mortgage principal. It's a pretty common sense, very easy, very practical way to actually attract depositors if you're the bank, but also as a client, as a consumer, and you have extra cash, you need to park some of that for a while. It's a great way to actually reduce your total interest by using money you already have. So let me give you some numbers to really kind of draw as a reference. If I were to owe $300,000 on my home and I happen to have $150,000 sitting on the side where I needed to park and keep idle for a while, my lender might only charge me interest on $150,000 of mortgage principal while I have those dollars there on deposit. Now, even if you don't have $150,000 on deposit, maybe you only have $10 on deposit. The reality is that here in the United States specifically, these two types of accounts are kept separate, right? Our debt is kept separate from our money, our cash. But if you really think about how our cash is managed, the reality is that we really don't get that high of a return by putting money in, say, a savings account or even a checking account per se. There's near zero interest earned on our money as it flows through our cash accounts. Especially when you compare that to the amount of interest you're paying on your mortgage, right? So it seems kind of lopsided. These two things, these two components are kept separate here in the US. And this is where the all-in-one loan really breaks down that barrier between the two, pulls them together, and is really founded on the offset mortgage concept popular in overseas in other countries. So here's what we do with ours. With the all-in-one loan specifically, that cash account is a fully transactional checking account. Otherwise also known as a sweep checking account. The term sweep is very important because this checking account does not allow your money to sit there idle, earning you near zero interest, right? Instead, if you deposit anything into it, it automatically sweeps your money out of the checking account and into the mortgage, physically paying down your loan principal that very day. So in other words, if I owe $300,000 on my home and I deposit $1, at midnight tonight, that dollar will be swept automatically, paying down my mortgage principal by $1. The same thing occurs if I deposit $100,000 or $10,000 or whatever the case may be. Your loan principal is paid down automatically just by using the checking account. And there your money is freely available to you 24/7, John. So you could pull it out to pay your bills directly out of your mortgage. It comes with ATM debit, POS, Visa cards, online banking, mobile banking, bill pay, ACH transferring, direct payroll deposit. It's a fully transactional checking account embedded into the mortgage itself. What makes it also very flexible is that we replace the archaic, rigid one-way mortgage instrument that we use so commonly in the US with a first lien position home equity line of credit. So that's technically what the all-in-one loan is it's a home equity line of credit and first lien position that allows you 30 years worth of draw access to anything you put into it. And so that way you can pay your bills out of it, more aggressively pay down your mortgage with cash that you already have. And that's accomplished because of the way the interest is computed and charged. It's a simple interest, computed nightly, charged just once a month after the month is ended. So you end up avoiding a lot of interest just because of this design change with a mortgage. A lot of information.
Yeah, but you did, those slides really help out, Dave, kind of explaining the concept between the two instruments there. It's good.
Great. And of course I can cover the loan's terms if we have enough time on this webcast, but that's essentially what it is. It's founded in the offset mortgage principle that has now expanded globally, become very popular. And we, as you know, John, we of course have our tax deductibility benefit still in the US. This is still deductible. The tax code still applies to this loan as well. But we believe that avoiding mortgage interest and excessive costs that come with having to borrow money is good for Americans. It's just simply good for American, real estate investors. It's good for those of us that are just trying to get ahead in life, save for our own retirement needs, our kids' college tuition cost in the future, all the things that we have to fund. If we can avoid a ton of interest, tens of thousands of dollars of it, then those other objectives are easier to achieve.
Okay, so guys, I have a chat box open. You can put questions in here in the Q&A, and I already have one question. I'm going to get to that in just a second, Sandy, okay? Dave, how do you test drive this vehicle? I mean, how do you know that it's going to work for you? Who's the ideal client, and how are they going to know?
Yeah, absolutely. First and foremost, you've got to have 10% equity in your home or 10% down payment for a purchase transaction just to begin to qualify. Good credit score, from the qualifying aspect that it's somebody that's credit worthy that way and really tends to be fiscally responsible or financially aware and serious about their financial future. But test driving and making sure that it's a suitable loan product compared to any other conventional mortgage product, we actually have an interactive simulator that can be leveraged, and it just compares any traditional mortgage to the all-in-one loan. And if you don't mind, John, could I show that on screen?
Absolutely, let's do that.
Great. I would like to do that. Let's see. Pull this up and okay. Let me know if you can see that. It's our interactive simulator. Great. Okay. Now, of course, this can be found at aioloan.net. And John, I believe you guys also have it on your website as well, but it's very easy to use. It's interactive, so it does come with some videos that help explain how the loan works and really who it's intended for and how it benefits people. You can actually save simulations as well. So maybe there's a couple of different scenarios that you want to run, with a couple, for instances, or what if examples. What if we renovate the house in 60 months? What if we do this or do that? It allows you to save those and come back and draw up any past saved scenarios without having to enter in any personal information. So it's really consumer friendly. The way you navigate through it is you just hit the get started button and you put in some information and you drive to the results screen pretty rapidly. So I'm going to do that for you just on screen so that you can all kind of see how this works. I'm going to put in a purchase price of about $425,000. I'm going to actually, let me bring that up a little bit. Go 475. I'm going to compare this to a 30-year mortgage. I'm also going to put in a loan balance here of about, we'll call it 380. Interest rate on that mortgage today, let's just call it 4.25. And I'm going to enter in the payment amount, the principal and interest payment amount on that per month right there. We're already done with screen number 1. I move into screen number 2, which is just deposits. And again, because this loan works like a bank account, in other loans, your cash flow behavior and how well you live within your means really doesn't matter after you close your loan. On this loan, it does. You get to really control your principal balance and your interest cost by way of your own cash flow behavior, whether you're a saver or you're just your conservative spender and you just live well within your means. This loan will benefit that client. So I'm going to go ahead and put in some income here on a net basis. We'll drive in about $6,000 for maybe borrower, and we'll plug in here $2,500, maybe on a biweekly basis for a co-borrower. And I'm just going to go ahead and hit continue.
Now, Dave, while you're there, let's clarify what that income is exactly. Is that their gross income from their paycheck we just put in there, or what?
Great question. It's actually not. It's a net basis. So after taxes, withholdings, the level of cash flow that would flow through an actual personal checking account is what we want to capture in this simulator, because that's what's driving your principal balance down. When you make a deposit in the all-in-one loan checking account, your principal balance drops that day by an equal amount. Therefore, you begin saving interest that month. So you'll want to put in the net figures.
Okay.
In the withdrawal screen, you've got a couple different options here. You can actually itemize out what your expense levels are on a weekly basis, quarterly, annual, so on and so forth. It already pulls forward the mortgage payment that is proposed. Or there's an easier way to actually drive through this, and that's to back in to that question by answering in a way that describes how much money residually you have left over. So instead of saying, here's what I spend, you actually just put in a percentage amount of what you don't spend typically to support your living expenses. So I'm going to plug in 15% there, which is pretty typical. This would simulate a family that's used to spending 85%, give or take, of their disposable income on their living expenses, including that mortgage. And then I'm going to go ahead and hit continue. And you're in the results screen. And this is comparing a 30-year loan at 4.25% versus the all-in-one. And we, by default, assume that the rate on this loan is going to be higher because we want to test suitability, and really create kind of a very conservative result estimation to really compare benefits. And you see here on screen that this quickly assesses the situation, allows you to toggle back and really change things and really drill down to get the numbers accurate and detailed. And it'll show you whether this is beneficial. Is it going to save you time? And will it save you interest costs? Those are the two things that it provides. And it'll be clear to a user of this pretty quickly. So, you know, that's how you use it. And you can see here with this example, this customer would pay off in a little over 12 years because they're avoiding interest to the sum of about $114,000. And that's just by using this mortgage as their primary checking account and allowing it to sweep over, and then they spend freely on their lifestyle, and we're helping people avoid costs so they can have more of their own money left over to fund those more important needs other than just their mortgage.
That's great, Dave. And so what happens at 12.9 years when they've paid the mortgage off? Does it go away or what?
Great question. In fact, I'm going to come back here to my PowerPoint, if you don't mind, on screen.
Yeah, yep, we can see it.
Yep. Okay, great. And I'm going to show you the terms of the loan. And this will really help answer your question pretty rapidly. Let me know if you see that on screen, John.
It's there.
Okay, great. So again, this loan is a home equity line of credit in first lien position. There is no balloon payment. There's no 10-year restricted draw timing of it. There's no amortized payment amount. You have full access to equity dollars and your deposits, anything you put into it, for 30 years. The way that we accomplish this is that the line of credit availability is level or unchanged for the first 10 years, meaning you could pay down as rapidly as you want to and draw back up to that maximum limit for the first 10 years evenly. And then from year 10 down to year 30, we're going to reduce the line of credit limit by 1/240th from year 10 down to year 30 to achieve zero. We want to pay off. We want a worst case payoff maturity date of month 360. Now, everything in between, let me give you some numbers to this. So if we were borrowing $400,000 on a credit limit, that means it would be at a reduction on a monthly basis of $1,666, right? Your principal balance, everything in between your principal balance and that credit limit is available home equity dollars, free to use for whatever the purpose might be. So to answer your question, John, we see people pay off so rapidly on this. You do not have to close it. It's a flexible credit facility for the home for whatever your borrowing needs are, whether you're writing a check to buy another property. We have many people that love this loan for investing in real estate and managing their real estate that way. Also, cutting a check for college tuition, but you don't need to close it. You can keep it open.
Excellent. All right, Dave, let's get some questions here. Sandy wants to know, why is this loan better than overpaying on my existing mortgage?
It's a great question. It's a common question. I would say that paying extra dollars towards your current mortgage is always a good idea in terms of saving money. You'll save money, you'll save some time. Whether you feel comfortable enough to use a lot of money is a different question. That's a personal question that you need to answer. Many borrowers out there don't actually prepay mortgages very aggressively, and that's because they're closed-ended instruments. So is it a good idea? Could you create savings and generate some time savings? Absolutely. Just the mortgage industry as a whole we haven't made this very easy for people to achieve. This loan does. And I would say that it really makes it even more possible and easier because it's designed for you to be able to leverage your entire paycheck. Consider how much income you flow through your own personal checking account. Consider how much you may have in your checking account right now, or over the next 10 years of your life. What if every single day those dollars were working for you? You put them to work, all of it, not just a little bit of it, but all of it, to help you avoid interest costs. Interest is computed nightly on this loan. So if every day your idle money, the money waiting to be spent on your cell phone bill in 2 weeks, was being leveraged right now to help you avoid interest costs this month, that helps to compound your savings over time more aggressively. And that's more effective. It's a more effective way to use your income. It's a more aggressive way to actually pay down faster. I'm not saying it's a bad idea. I'm saying that a lot of people don't do it because the tools we sell don't make it easy.
And remember, guys, if you have a fixed rate mortgage that you have on your property and you pay aggressively on that, anything you pay into it, you're not going to get back out. It's not like this loan. If you wanted to pull those funds out for either an opportunity or an emergency, those are the two things. They're not available there unless you refinance. With this loan, you see the amortization schedule there. It's available underneath that line. Yeah. Is the checking account FDIC insured, Dave?
It is. The way to think about this loan is because it involves two components, the checking account and the home equity line of credit bundled together. They're integrated and they come together. When your money is deposited into the checking account, it only remains in the checking account until midnight, Eastern Standard Time. And then it sweeps automatically. So while your dollars are there waiting to be swept, they're FDIC insured to the federal limits, which I believe are 200,000. And then once they're swept, you're actually converting your cash into home equity dollars. And if you watch on screen, let me give you another quick visual aid here, just to help understand a little bit further how this loan works on a monthly basis. And I'm going to start with an example here of $300,000 with a deposit of $8,000. At midnight, that sweeps, and you can literally wake up the very next morning and see that you've converted your income dollars or your deposit into home equity dollars, cash into home equity. And that's completely available to you 24/7 for use. From there, interest is then computed. Interest is computed nightly after any sweeps or deposits and withdrawals and sweeps. It's simple interest based on your unpaid principal balance. And then that's just totaled up at the end of the month. Each day's interest is totaled to become your interest payment that becomes due the next month. And so here's a couple examples here. If we've deposited $8,000, we've reduced our interest expense that very next day by $1.37. Now that doesn't seem like a lot. That's just one deposit, right, on one single day. Imagine what you could do with your income dollars over a stretch of 3 years, 5 years, 10 years. You could end up saving a tremendous amount of money just by using the account as you normally would any other checking account. So to kind of flow through here, as you spend out of the account, you end each month at a lower balance. Interest is computed nightly, totaled at the end of the month. And what you don't spend out of the account remains there as home equity dollars. Your home equity dollars are actually insured by a proper homeowner's policy, right? So your asset in the home, your wealth in the home, your equity stake in the home is covered by a proper insurance policy. So to answer your question, it's both one part FDIC insured while your cash floats through the checking account. After it sweeps, it becomes home equity dollars. And there it's insured as all your ownership in your home is through your homeowner's policy. And I hope that clarifies and makes a little sense. Plus I wanted to embed that, get that graphic illustration in while I answer the question.
Okay. I got some other questions coming in here. So Dave, I'm going to combine. Marcia has two questions combined. Do you know the strategy where someone would take a line of credit and a first mortgage and they use the line of credit to pay down the first mortgage and then aggressively pay on the line of credit? How does it
Absolutely.
compare with that?
Yeah, absolutely. Yeah, and I like to tell people the concept of saving interest and avoiding costs. It's a good idea. It's not a new one by any stretch. We developed this loan out based on tools that were developed and to harness that idea and make it much more efficient for people. So the concept of using a second lien HELOC or an outside credit line to help you more aggressively pay down your primary mortgage. It's an idea that's been out there for a very long time. A lot of people know about that, but it's a very manual process. I would say to compare the all-in-one loan to that concept or that strategy, the all-in-one loan is a set it and forget it. It does it for you. It's fully automated. It removes the problem through a refinance or the purchase of a property. The problem is an amortized mortgage. That's what defines your cost, the excessive cost of borrowing money on real estate. That is removed by putting this in place. From there, anytime you make a deposit, it's done for you automatically. You don't need to manually move money from account to account. Remember to do that routinely. For a lot of people, that's not a problem, right? And I'm not going to say that it is. To each his own. But this just automates the entire activity and leverages anything you put into it automatically for you and allows you to pay your bills directly from it so that you're maximizing the time value of your money in one account. That's the benefit. You're picking up that arbitrage. Even for a day, if you have a few extra dollars in this thing, it's saving you interest. And that's where it begins to differ from those manual strategies, like using a second lien HELOC. I would also add as a kind of a closing comment on that question that the interest calculation on this loan is daily. Simple interest, recasting automatically every 24 hours. So unlike most HELOC products that are available out there, this one computes interest daily, not charged daily. It's computing or recasting interest daily. And most HELOC products don't do that. They generally compute interest on a monthly average balance, not a daily principal balance. So those are some of the big differences.
Okay. Francine wants to know, I have a 30-year loan and we're retiring this year. Congratulations on that, Francine. Would you advise me to do this all in one loan?
Potentially. It really depends on what your future goals are. We don't position this product as a just in case I need access to home equity dollars in the future. The chances that you will need to leverage your equity in your home are statistically probably pretty high. However, you might consider just getting a lower cost home equity line of credit for that purpose if you'd like. And of course, John and his team offer those products as well. However, if you anticipate having mortgage debt for maybe longer or taking on more debt in the down range, I certainly would encourage you to consider this as an alternative to either refinancing your current mortgage or getting a second lien HELOC. It really depends on what your future goals are. But we want to make sure that this loan is put in place to meet those goals. And if it doesn't meet those goals because you have alternative needs, then there are probably other products that might be more suitable if you're on pace to have your mortgage paid off this year. And congratulations, by the way.
Yeah, exactly.
Awesome.
Here's a simple. What's the maximum loan amount for on this loan for a home, Dave?
$2 million today. We'll make exceptions above that as well. So $2 million is our cap, though.
Now, if you're a $2 million loan, what's the loan to value typically you will allow for that loan?
70%. So you need 30% equity in the home. Yeah, it's a great offering, though. Absolutely great offering.
Yeah. Dale's got a question. I'm not sure if I understand this, Dale, but I'm going to read it to Dave here. How about business owners who are S-corps and taking salary plus draws? This is based on project-based consulting fee payments. And I think what Dale's talking about is you have variable income. Yeah.
Yeah, and you're a business, right? You're a business owner. So About 30% of our portfolio who we've funded loans for are small business owners, and it's interesting to watch the characteristics of their balance, because we see large sums of larger deposits hit the account, and the principal balance dropped significantly, which is great. And then we see large sums of capital or equity dollars removed, in 30 days, 20, 30 days. And that's probably because those business owners are needing to meet their, payroll and inventory, requirements, things like that. This is a phenomenal opportunity for business owners. Any high commissioned earner, inconsistent earnings, as well as just a regular consistent earner. But I mentioned the business owner specifically because you could write yourself a note, borrow from the business. It's legal for S corp sole proprietorships to commingle personal assets with but for accounting purposes, you'd probably want to take an extra step in there. But it provides that option. Whereas, the traditional way of managing real estate, or at least borrowing for real estate, doesn't come with an option to be able to do that. Avoid costs on the borrowed funds with capital you already have in one place. This is the way that most large businesses manage their liabilities and their assets in one place. If Microsoft, for instance, could pick up a day of savings on the $1 million of capital they're moving through, the same instrument they manage their debt from, they'll do that because it's a big savings. You bring that down to our level, our scale, it's just regular consumers and with mortgages. That's the idea behind the loan, but pennies become nickels, quarters, dollars, and dollars, tens of thousands of dollars in savings that you can achieve. And I'd say the biggest benefit of this loan is it provides that level of optionality for business owners, wage earners, you name it, a ton of opportunity to use the money you already have to save automatically in mortgage interest on the debt you've already committed yourself to. That's the real benefit of it.
Okay, Morgan's got a great couple of questions I'm going to combine into one. So what happens if you have multiple properties and you want to do as many of these as you can? So a couple of questions embedded in here, Dave. How many of these can one client do? And then secondly, can they put them all, how Morgan said it, can you put all the mortgages together and run them through the same checking account so you get the maximum advantage? How would that all work?
It's an interesting question because that's exactly how it's evolved in other countries. That's really called cross-collateralizing, whereas you can use one instrument to really finance multiple properties. We're not there yet here in the U.S. You'd need one loan per property, but that doesn't mean that you can't have one loan on one property and still manage saving money on multiple properties. It's exactly how I personally have used this loan myself, to buy and invest in real estate. And then I would take extra cash, my savings, that I would realize through this loan, and I would prepay down my conventional mortgage on my investment properties more aggressively. So really, really helping me avoid interest in multiple areas. But to answer your question specifically, it's one checking account that comes with one loan. How many can you have? Technically, we can provide up to 3 per borrower. So 3 different properties could have 3 different all-in-one loans on, for one particular borrower. The question then becomes, let me just add this. The question then becomes, are you truly maximizing the time value of your money? You'd have to, and we could simulate that. John and his team could actually simulate that through the simulator. Like, how would that impact you, or maybe even slow your progress down? And maybe is it better to have one on one property, use your money more effectively that way, make a lot of principal reduction, and then begin to use that same credit line to pay more aggressively on those other properties instead of separating out your income in multiple different areas. That may be a better strategy, but it's all about math. It's just about financial, logic and financial benefit or not. And that's really what John and his team can assess. But it's possible.
Absolutely. So 3 maximum, could that be 3 non-owners, or does one of them have to be owner, Dave, or how's that mixed?
Yeah, great question. The funding of it means that we can provide, an all-in-one for one investment property, 1 primary residence, and 1 second home. There's your 3. Right. So that's the way we would do that. We can't provide this to multiple investment properties for one particular borrower. But what we see a lot of is we see a lot of people applying for 2, 1 on their primary, 1 on their investment. We see that a lot.
All right. Scott wants clarification. A good question, Scott. Does the monthly payment vary, or is it set and the underlying principal interest ratio varies based on deposits? So explain that one more time. What's the payment look like on this loan when you put, large deposits in and out and all of that?
Yeah, great question. The way to think about the payment on this loan is that we've separated the principal from the interest, right? The traditional method of making a payment on any loan, boat loans, motorhome loans, mortgages, that P and I are coupled together in one, and you send a check away to your loan servicer, and relative to your amortization repayment terms, very little of that for a very long time is actually applied to principal. This loan separates the P from the I. Your deposits pay down principal immediately, automatically, and first. From there, interest is then computed according to your unpaid balance, just whatever your principal balance is nightly at midnight. And that gets totaled at the end of the month. And that monthly interest cost, right, each day's interest for that month becomes your interest payment. That's the only thing you have that leaves the account, is just the interest portion. You're in control of your principal reduction by way of depositing and withdrawing, interest calculated nightly, totaled at the end of the month. That interest amount is then drafted from the all-in-one automatically. You'll see it debited. You'll see your principal balance bump up just a little bit to pay for last month's interest. And that occurs on the 21st of each month. So on April 21st, the interest payment will be drafted from all of our all-in-one loan customers to pay for March's interest, so on and so forth. To answer the question a little bit more specifically, the great benefit about this loan is that interest payment is engineered to reduce. That's what it's designed to do. Let's reduce your outgo of your money, right, in the form of finance charges, interest. Let's reduce it. How do I reduce it? Well, I'm going to give control to the borrower. I'm going to give control of the principal balance in which interest is computed completely to the borrower. That's how you get to avoid interest costs and reduce your interest payment. So your interest payment can vary relative to your behavior. You want to leverage your equity dollars and cut a check and buy another property, or whatever happens financially speaking, a challenge or an opportunity, your principal balance will follow and your interest cost may rise because you're spending money. Or you can pay it down aggressively and you can reduce your interest amount. It's really up to you.
Okay. A couple more questions came in here, Dave. Are these loans only available for single family, or how many units?
Yeah, 1 to 4 units. So single family and then 2 to 4 unit, multifamily homes as well. Awesome opportunity for those of you that may have, a multifamily home. Maybe it's your primary residence. Maybe it's an investment property of yours. Imagine taking your rents, right, and getting those rental checks, that rental income on a monthly basis. You've got to typically deposit them somewhere, right? Some checking account, and consider really, and I'm not beating up on banks and credit unions and all the other institutions out there that provide checking accounts. I'm just saying, ask the question. How much money am I driving through these accounts? A lot over time. In fact, there is no greater source or sum of money than your own income throughout your adult life. It's actually, your checking account is your biggest asset in life. It sees more money than any other financial tool you'll probably ever use, personally speaking. And because we've embedded a checking account into the mortgage, which happens to be also statistically your largest expense in life, you can really leverage not only your own income, but also other people's money, right? Your rental income, deposits, things like that, directly into the mortgage. So you're now saving interest, which grows equity faster. A phenomenal way to manage investment properties as well as your primary or second homes. But 1 to 4 unit properties are allowed.
Okay. Morgan's got a good question too. What if you want to do just your rental property? Do you have to have it on your primary, or do
No, not at all.
you have a primary? What if you're a renter? I'll extend that question, and you have a couple, 3 rentals. Can you do it on those?
Absolutely, perfectly fine. A lot of people do that, actually. Yeah, don't see the value of buying yet for their own primary, right? Maybe they're not at that place in life, or for whatever reason, maybe they're in between homes, in between primary residences, right? Perfectly fine. Absolutely, you can do this on an investment property, even if you don't have a primary residence, but you don't need to do a primary residence first at all.
Awesome. Let me summarize a couple things here, guys. So what Dave has shown you is a product that he offers, I would call it maximum flexibility in terms of you controlling your money. And I know from my research on this, because I've looked into this loan a lot before we started offering it to our clients here, is that it tends to modify the spending habits of people who have the loan. They become really good savers because they recognize how powerful it is when they keep money in the account and don't keep spending it and all of that. So that's good, right? And as he said, I want to reiterate something Dave said, because it's very powerful. you're taking your largest asset in life, which is your income over a number of years, and you're using that to leverage and pay off typically what most people's largest liability is, which is their mortgage. And you can pay it off in a very, very rapid manner. I had a client which I was kind of uncertain because the answer was too good to be true. And I got Dave on the line. He went through this scenario with me, and this guy's going to pay their loan off in less than 5 years. And they were comparing that with doing a 15-year fixed because they thought that might be the better way to go. It's really a matter of your cash flow and how well you manage your money and how much money goes through that particular checking account, which is associated with that particular loan. Is that all correct, Dave?
Yeah, absolutely. I would let me give you another little nugget to think of, or a way to think about this loan. You know, mortgages, the vast majority of mortgage products that people use historically, the 30-year fixed, 9 out of 10 borrowers leverage a 30-year fixed or use a 30-year fixed. The gold standard in the United States, about 4% only use a 15-year fixed. And the balance of that, the market out there is using ARM products or other loans. These products are products of the Great Depression era, really put to market in 1934. And so it's just a weird concept when you really think about something so important to our society, to us personally, as real estate, as home ownership, that the products we use to finance, buy them and finance and manage them really haven't changed at all. I'm not talking about guideline differences or risk tolerance levels changing, depending on market environment. I'm talking about how real estate is paid for. And these loan products haven't changed since 1934. And I just like to advocate that it's about time our industry steps up and begins to really consider, how do we make home ownership more affordable, more flexible? How do we reduce the cost of the money we need to borrow? It's a necessary evil for most of us. And that's what this represents, a better way to actually buy and manage real estate, for your future needs. The way we accomplish that, I'll leave you with this, is that we remove the amortization schedule altogether, because that's what actually defines your cost, not the interest rate alone. The amount of time you're in debt, as well as how your principal balance is being reduced, whether it's reducing or not, and who's controlling it. Those actually impact your cost to a greater level, mathematically, financially speaking. This loan changes everything. It just simply provides full control of those things to the borrower so that you can dictate or define when you are out of debt and how you want to leverage your house for the future. And the way we accomplish that is by embedding a checking account in it. That gives you full control with money, to John's point, with money you already have, the cash you already have and you earn, which is life's greatest resource.
Absolutely. So I'm going to end our part of the presentation here. Scott's got a really good question, like, how do you know what term, what rate, what loan to value is applicable to you? Well, guys, what you're going to do is you're going to reach out to your loan officer that invited you here. We work directly with C&G in this loan. We have the little scenario simulator there available that Dave showed you. And you can do it in a couple different ways. My suggestion is, from experience here, is that you kind of walk through it with us the first time through to set up the simulator so we can see what it looks like for you. And then you'll get a little code which is unique to your simulator, and you can play with that all you want. And you can fine tune it all you want. And we'll tell you what interest rate applies to you and what the cost is and what the maximum loan is available on, depending on the property and all of that. And then you can compare that with the other loan products that we still have available for you. So remember, the goal of our seminar here, all of our webinars, is to educate you so you can make good decisions. And this is just one more webinar designed to do that. So you can take a look at this loan, which is not the best loan for everybody. It's just a great loan for perhaps somebody, right? And compare that with other loan products we have and see which one is the best for you. And then you can make the choice based on that.
Yeah, great way to summarize it, John. It's interesting how we continue to sell one single product to the vast majority of buyers and borrowers out there, the 30-year loan, when we know that we're all individuals. We have different goals. Each of us, every single household is uniquely different. This loan kind of customizes or tailors the results of it, right, to each individual household depending on their behavior, right? And so I love the way you summarize it that way.
Okay, guy. Well, Dave, I want to thank you for your time. I know you're a really busy guy. So thanks for taking some time out of your busy schedule and explaining this interesting and unique loan product to us, which is excellent for the right person.
Yeah, John, thank you.
Very well.
I appreciate it.
I want to say one more thing for you, those of you in Hawaii. The loan is now available in Hawaii, and that's relatively recent over the last year or so. And it so happens Dave is going to be visiting Hawaii at the end of May. Am I correct on that?
Out there on work, yeah. For work.
So we're going to line up your schedule here. So if you want to get a live version of Dave and talk to him face to face, we might be able to do a presentation over there in the Hawaii area someplace. And I kind of twisted his arm a little bit. And he said he'd be available to us on his vacation here. How about that?
Keep me out there. Keep me captive. Invite me out. I would love to spend some time out in the great state of Hawaii. So look forward to that.
Yeah, thanks, Dave. And please, guys, don't be calling Dave directly. Remember, he's a busy guy. He's over wholesale and all of their operations there. The loans actually come through Pacific One Mortgage, Bay Equity, and we broker them directly to CMG, and we work with them to get them closed. So any questions you have about loans, direct that to your loan officer. That's the appropriate person.
Perfect. John, thank you.
Dave. Appreciate it. Good to see you again.
I hope to be back. Thank you again.
We'll get you back in here sometime, I'm sure.
Great.
Okay, let's see if the recording is off.